have Seth Freeman on with us. Seth, hi, very good morning to you, and great to have you on. I'm just wondering what you made of some of the commentary that came in from Fed Chair Jerome Powell. Let's start right there.
Well, welcome to the chaos in the United States. The most interesting part was how he kind of downplayed some of the uncertainty in the Trump policies and the implementation of Trump policies. He actually said policies have an effect at the margin, but that he wanted to see how they roll out. It certainly created a lot of uncertainty. It's fairly interesting about the numbers about employment figures after there were offers made to 2 million federal employees to stop working, take early retirement, or quit. I think I was reading an expectation that maybe there could be 300,000 or maybe even 500,000 government employees who will soon become unemployed. So I'm not sure how this all fits in.
Okay. Seth, talk to us about the trajectory then. Are we still building in just a couple of rate cuts, and when do you anticipate that they will come through?
Well, obviously the chairman says this is a pause. I think we're going to have to wait and see, what happens. I do believe that these policy pronouncements will have quite a lot of impact. Consumer spending is really what drives this economy. Consumers are continuing to spend, although personal credit is at a very high level, and we still have very high prices, which puts a lot of pressure on. So looking at core inflation, and it's uncertain what's going to happen to oil prices and other kinds of commodities.
Geoff Dennis with us as well. And Geoff, Seth Freeman out here is saying, welcome to the chaos that is the US, and couldn't agree with him more when you look at the the exchange between the two men. But from a market's perspective, Geoff, it almost seemed as if the Fed commentary was anti all the key things that the market would like, right? I mean, hawkish on all the three counts of labor, inflation, as well as the economy itself. Is the market to presume that 2 rate cuts are indeed a bit of a good hope and a far-fetched expectation, if you will?
I think it's hard to say. By the way, I love the comment about chaos because it's absolutely correct. It's a crazy situation we're in with Trump versus the Fed, etc. My call already all year, or for the year, has been 2 rate cuts. I think it's still possible we'll get 2 rate cuts. All I would say at the moment is that the case for a rate cut is very slim, and I think that's what Jay Powell said today. And he highlighted that in terms of the strength of the labor market, and also removing that comment about inflation gradually converging on 2%. So right now, and he said this as well, there's no real case for what we know about the Fed and its goals to cut rates right now. And of course, although he didn't talk about tariffs and tax cuts and all that sort of stuff that Trump talks about, I'm sure behind the scenes they're thinking about what the implication of those could be, depending on when they happen and how big they might be, etc. The market is uncertain. I don't think it was an overreaction. It was a negative reaction. And the market's held up pretty well, given how hawkish the Fed was. But as you've said there, I don't think there was much coming out of the Fed here that was particularly market friendly. And right now, you've got to see quite an improvement in the data on inflation and a much, I guess, a somewhat weaker labor market before we really start talking rate cuts again from the Federal Reserve.
Geoff, just one point that we made early on today, and I want to know what you think about that. In fact, a lot of people have taken note of the fact that there was no mention of the glide path to 2% inflation. And that is being seen as a signal as well. Obviously, a lot of people have been talking about the policies that Donald Trump espouses and what will likely come about in the next 48 hours or so, what we're watching very closely on the tariffs, that is going to be inflationary. And so is this a signal from the Fed and the FOMC that says, look, we take stock of this and we're not going to talk about 2% for a while?
Implicitly, maybe, but explicitly, no, because indeed it is true that we're not, the glide path towards 2% inflation appears to have stalled out around at 3 or just below 3 for headline, just above 3 for core. So if they really are committed to getting it actually to 2, we're not making a lot more progress right now. Now, we may see more progress over the next few months. So it so happens that that would dovetail very nicely in with the Fed saying behind the scenes, because it's not going to say it publicly, that we want to wait to see what Trump does in terms of tariffs and in terms of tax cuts. I myself am concerned about both of those. It could be, witness the extraordinary episode with Colombia over the last few days, that he's going to use tariffs as a bargaining chip. But he wants to do tariffs. He wants to cut taxes. They are both inflationary, in particular, in my opinion, the tariffs. The fiscal problems, the fiscal cuts will be, the tax cuts will boost the budget deficit, which is going to be, I believe, bad ultimately for bond yields, everything else held constant. And so what the Fed is seeing now happens to dovetail in very nicely with the idea that they want to wait and see with respect to Trump. So at this point, there's no rate cuts on the table unless we see some of the points that I've just made.
Geoff, just trying to understand, after all of the uncertainty, and I think when we look at the Fed today, we need to look at what Jerome Powell says and what President Trump has said after, where he has said that he's going to do everything under his power to bring down inflation. When you see those two statements together, coupled with all the commentary on tariffs, and we might see some clarity on that in a couple of days, how are you looking at the inflation picture? Is there anything emerging in a clear way?
No, I don't think so. I mean, I'd love to see how Trump is going to bring inflation down, given his policy, given his policies. Unless he's going to fire all the government workers, he seems to want to fire quite a few of them, because that would certainly have some sort of impact. And a point we haven't mentioned either is the potential deportation of millions of immigrants, unregistered immigrants, and which could certainly squeeze the labor market somewhat. So for me, I personally, my attitude has been for a long time, I'm not sure what is so magical about a 2% inflation number. You know, we ran this economy for a long time in the past at 3-4% inflation, and I'm a little surprised they want to completely focus on getting it to 2. But if that's what they want to do, there's nothing going on here, I think, at the moment, which is going to show us a quick move down to 2%, even though the numbers may well improve a little bit over the short term. And so, as I say, that gives the Fed the option to just sit and wait to see what happens, because if you get tax cuts, the budget deficit blows out, as I've said, and if you get tariff increases of tariffs of the sort of breadth and size that Trump is talking about, they are definitely inflationary. U.S. consumers pay those tariffs. The overseas exporters don't pay the tariffs. He's got that economics completely wrong. And if the tariffs do come on, it is going to have an effect on inflation. So the Fed can happily sit and wait here now to see whether we get to 2 and to see what Trump is going to do.
Okay, so it's wait and watch from the perspective of the Fed, certainly. But what about the markets and what about investors? Does the status quo continue, Seth? Does the flow away from capital markets in emerging markets continue? Would you still be long on bonds?
No, I would not be long on bonds. I actually think bond yields are going above 5% at some point this year.
No, sorry. The question was to Seth, actually.
Oh, forgive me. Sorry. Sorry.
It's okay. I agree with Dennis, with Geoff, actually. Bond yields are going to be driven higher, and it's completely, opposite of what Trump is trying to do. Mortgage rates, of course, are indexed against 10-year yields, and there's a huge problem here with access to mortgage loans, and the real estate market is very tough. And it's also extremely negative for emerging markets and money flows because the higher U.S. rates just increase the risk orientation towards emerging markets.
Seth, Geoff, thanks so much for joining us this morning. Very interesting perspective from the both of you.